Another probability increaser for supply and demand zones that we can use in our trading would be using the concept of liquidity, more specifically the sweep of liquidity when a zone is created. So if we have an example of equal highs, a sweep of those equal highs, and then price continues to move to the downside in a rapid manner, we have a formation of a valid supply zone. Then the flip side, we would of course have equal lows, a sweep of those equal lows, and then a move away, creating a valid demand zone. We can also have a similar situation where we have a swing high, a sweep of that swing high, and then a rapid move to the downside. And then on the flip side, a swing low, a sweep of that swing low, and then a move to the upside, forming a demand zone. Now, of course, in many of these cases, we're also going to get a break of structure, but not always are we going to get a break of structure. So the combination of breaks of structure and sweeps of liquidity are going to be massive probability increasers for supply and demand zones as we're looking at price, because what this is showing us is that price is taking out liquidity before a move's happening. So it's inducing more people to get in to a particular trade, because what it's doing is inducing orders, tapping into orders that exist above these highs or these lows, and then price is creating that imbalance for price to continue moving. And then we'd be looking at that area as our point of interest, our supply zone, or our demand zone. So what we'll do now is we'll jump into some examples here on the 15-minute chart, probably go through some of the similar ones we went through in the previous episode, but we're going to be looking at it through the lens of sweeping liquidity and just getting an overall understanding of liquidity being swept. So if we look on the 15-minute chart, but if we look at this, what we can see is we have a swing low, we sweep that swing low, we have a collection of equal lows, and then we sweep that equal lows. But what we can see is if we just look at these two lows, they are equal. And if we just look in the top corner of the trading view chart, we can see the open, the high, the low, and the close values. And what we can see is the low is 18,409 on this candle, and the wick on this candle is 18,409. So they are perfectly equal lows. So they haven't taken out each other, but what we can see is price has taken out the liquidity of the lows prior to that, because again, we're factoring in the fractal nature of the markets. We understand the importance of lower time frame and that this low is important on a lower time frame. We've swept liquidity and then we've continued moving to the upside. Again, we've broken structure. That validates our point of interest. If we look at this next one, what we can see is we create a swing low right here, a collection of swing lows right here. This point of interest, or this point here, this candle, this doji, creates a range. It takes the liquidity and then we break structure to the upside. So therefore, this is a high probability demand zone. Why? Because we've broken structure and we've also swept liquidity before the formation of the zone. And what we can see is we get that reaction and price then begins moving to the upside. If we look at this zone, what we can see again is we haven't actually swept any liquidity. So that doesn't actually add any value to that. It's just a break of structure. If we look at this one, what we can see is we have a swing low here. We do take out some liquidity, but again, when we were looking at this, we start seeing a bunch of this liquidity being stacked, liquidity void. We have some inducement here, but all the while we know that this zone is just creating a lot more liquidity in the form of internal range liquidity, the inducement before the demand zone, and price then continues moving to the upside. So all of this does not include really any sweeps of liquidity that we really need to concern ourselves with. It's really just looking at something like this or something like this. Now, of course, you can get into specifics. Yeah, of course, we've swept liquidity. We've tapped on this. We got a small reaction, but we barely broke structure. We have a lot more liquidity resting under here, so not the greatest area to be looking for buys given that bit of information. What we can see here is, yes, we did sweep liquidity. We created equal lows, we swept liquidity. So in theory, we could look for a demand zone in this area. We also break structure, so the validity is there. But again, we didn't break structure with a lot of force, and we're starting to see these stacked lows, which gives us the indication that we're just creating a lot of internal range liquidity. Again, as we had mentioned in the previous liquidity videos, this ends up being a variance on the 4 hour, where price is still bullish on the 4 hour. We have that strong push, and we're just seeing the 15-minute changing its character a little bit before we get the true pullback on the 4 hour chart. We'll just move on. Most of these haven't taken any real liquidity. Yes, we have a swing high here. Yes, we have a swing high here. And in theory, on lower time frame charts, yes, maybe that would be a sweep of liquidity, but for simplicity's sake, we'll disregard those because we don't see a clear form of liquidity, so it's best to just move away from that. So So I'll just carry on and look at this bit of price action. What we can see is we do get a bunch of equal lows here. We sweep liquidity, we tap into the zone, we do get a reaction, but then the reaction fails. Where does the reaction fail to? We react to this area right here. Again, no real sweep of liquidity, we just get a break of structure. So not the most clean cut or best examples to run through, but just to run through the same examples that we ran through in the previous video, where a lot of these were geared towards break of structure plays. What we can see, if we're just looking on the demand zone side of things, is we sweep liquidity, we create a point of interest within something like that where we get this pivot. But as we can see, and as I mentioned in the previous episode, is that we don't actually tap into that demand zone, but the rationale and the logic is still there. What we can see is we get some inducement, we get a liquidity sweep here. So what we can see is, although we haven't broken structure, we've swept liquidity. So we could be looking at this point of interest as well, or more specifically the wick. But as we can see, price doesn't actually tap into it. So we're trying to put the biggest probabilities in our favor, or put as many probabilistic factors in our nature. And what we can see is if we're just looking at this bit of structure, yes, we've broken structure here. Now we're operating within this range. Yes, we've taken out liquidity, but we haven't actually broken structure. And when we did break structure, this minor bit of structure, we didn't break it with any real force. So therefore, this point of interest, this demand zone, is probably not the highest probability or value for us. Now on the flip side, what we can see is we have liquidity here. We create a demand zone, we break structure with power, we come in and then we get a reaction, albeit slow moving, and we end up tapping into, again, this supply zone and move to the downside. But again, we can more than likely trade that about 27 pips. And then we'll just continue on a little bit further. Again, none of this swept liquidity. We took liquidity with this, so in theory, this could be a valuable point of interest for the future, but we don't know that for sure. Now what we'll do is we'll just jump into the 1 minute and go through the same examples as we did in the previous episode, just to continue driving the point home a little bit more. So we'll start in the exact same spot. We are in a downtrend on the higher time frames. We've switched bullish here on the 1 minute. And what we can see, if I just zoom in just a little bit more, we have equal highs, highs, highs. We sweep that liquidity and then we move to the downside. What we can see is we don't actually tap into that bit of price action, as we can see. What we can see is we start creating trendline liquidity and just swing high liquidity. We sweep it, that creates a valid supply zone, and then we get more liquidity. We sweep it and valid supply zone. Again, we break structure and we break structure. So we're just adding on to these areas of supply zone, because we know that this supply zone right here, this large candle, was valid because we broke structure right here. We broke this minor structure. We know that this supply zone is valid because we broke minor structure, and then we ultimately broke swing structure. But again, we can add on to that by also understanding that we took liquidity, and we took liquidity in the form of equal highs. And what we know is we took relatively equal highs, but more specifically swing highs and also structural trend line type highs. And we'll move on once again and just continue looking at price. What we can see again is price in this case just break structure. We don't actually take any true liquidity. We do have inducement, but there should be a difference between looking for a sweep of liquidity to form a point of interest, and then if we're forming some form of inducement, we would get something like that, where we've taken out liquidity to form our point of interest. We create inducement, or the formation, in this case, of buy-side liquidity, to fill the liquidity void, to tap into the supply zone, to then continue on. So there is a very big difference between inducement and liquidity. So in this case, this is inducement right here. We've created equal highs. We've swept those equal highs to tap into the supply zone. Then we continued. Whereas something like this, where we have equal highs, we sweep those equal highs, and then we see the momentum to the downside that creates the supply zone that we'd be looking to trade. Now, if we look at this example right here, what we can see is we have a swing high. We have a sweep of that swing high. It creates our change of character, and then price moves to the downside. We also have inducement, and we have price tapping into a supply zone, which is why this trade, and as I mentioned in the previous video, why this area was valid. It was just, you needed a little bit more probability to look for this, because we've broken such minor structure, and whether you counted that as structure is totally up to your own bit of judgment and testing. As we know on a lower time frame, so seconds, that this would be a change of character, and this would be structure on the seconds time frame, but if you don't trade or have access to the seconds time frame, which a lot of us don't, it's not something overly important, but it's just something to be mindful of. But yes, we have a very basic break of structure, but what makes this a little bit more high value is we have a sweep of liquidity, more specifically this sweep of liquidity, some of these equal highs here, or a collection of equal highs right here. It forms our supply zone. We do break that little bit of structure. We form a liquidity void, and we have inducement. Factoring in all of those components combined with the fact that we're already bearish is what makes this trade valid, or makes this supply zone valid to trade. Again, what we have here is we have the zone right here. We have our inducement, which in theory we could also view in this case, in this particular case, that this is the liquidity before this zone. We've tapped into this zone and then we've continued moving. We tap into it. Again, we have inducement. We have inducement. What we can see here is we swept liquidity. We've created a valid point of interest right here, but this is a zone that does not get tapped until much later. But as we can see, if we use this candle right here, or if we refine to something like this does wick it by like a pip, which is not a big deal, but something to keep in mind is we do get a valid point of interest, which is why this gets respected. So let me just make that a little bit smaller. You can see as we break structure, we break structure, we break structure, we break swing structure. This is that origin of the move that breaks that structure. We've taken liquidity, we tap into it, and then we continue. What does this end up being? This ends up being more of inducement to this tap into that zone. Getting a little bit messy with my lines there, but at the end of the day, again, we're trading lower time frame order flow, but we understand the higher time frame is bearish, and now we're starting to build up trade ideas. We're starting to see supply being respected, demand failing, demand failing, demand failing. We know that this took liquidity and broke multiple layers of structure, especially 15-minute swing structure, which is a little bit more valid and something we should be looking out for when we're trading the 1 minute. But we also start getting some inducements. We have an overall liquidity void that we're more than likely going to see filled. And then what we can see is we tap into that, and then we continue moving to the downside, and it gives us a nice tradable range. And then what we can see is, we'll just talk about this one. If we look at this, we have a swing high here. We take liquidity of that, especially this. We break structure. We tap into this supply zone, and then we end up moving to the downside, breaking more structure and continuing on. Now we've tapped into this higher time frame daily demand zone, and we're starting to see a change of character. What do we see? We see a sweep of liquidity. We see a break of structure, which is also a change of character within this higher time frame point of interest. This is why this ends up being valid. If we didn't have a higher time frame point of interest here and all we had was a sweep of liquidity and a change of character, and we're in the middle of nowhere, I would proceed with caution because we're still very much counter trend. But because we're in a higher time frame point of interest demand zone, this is where logically we could start to look for supply turning into, this is where we could look to start seeing supply failing and demand starting to be respected, if that higher time frame demand zone is going to be the catalyst to change the overall trend. And as we know with supply and demand, we're more than likely going to get a reaction from it, whether it's a full reaction that we can continue to trade or just a simple reaction that we can take small trades on. A whole different story, but this is why this becomes important, because if we're just trading this in isolation, you're going to have a bad time in many cases. But the fact that we've paired this with a higher time frame point of interest is what improves the odds of this happening. So sweep of liquidity, break of structure, which is our change of character within the higher time frame point of interest, range created demand, price taps into it and then runs off to the upside. Again, this one right here, you could argue that this took liquidity here before we move to the upside, but that one's a little bit harder to justify in my opinion because it just doesn't look as clean. So this is more of a break of structure play and a supply and demand zone flip, which we'll get into. And as we can see with this zone, sweep of liquidity creates point of interest, breaks structure, valid supply zone to look for selling. What we can also see here is sweeps a little bit of structure. Again, we're looking on the 1 minute. This would be on the seconds time frame. So this is about logically thinking what's happening on our time frames, understanding market structure, understanding liquidity, that this did break structure, although we broke some minor structure, and it did eventually break the swing structure on the 1 minute. So it is a valid demand zone. We do get that respect. But what we can see is we're starting to build stacked lows. We're starting to build equal lows. So the longevity of this trade is probably questionable. Factor in the fact that we have liquidity that's been swept here, a new supply zone that's been created. It's breaking multiple layers of structure. Gives us the indication that if we're looking to trade, this would be a logical spot to at least at minimum secure your risk, maybe even look for a hedge trade to see what ends up happening next. And then as we've seen, price takes liquidity and then continues more or less moving sideways, because as we can see, this is very much indicative to sideways price action. And then what we can see if we just move on, we tap into this demand zone, we sweep liquidity, we break structure. This becomes a valid point of interest to look for trades. What do we have underneath it? We have inducement or sell side liquidity that just rests above the demand zone. Demand zone could be in this wick, or we could just use this entire pivot, which would be just a larger zone that price is accumulating on, and then price continues moving to the upside. What do we see here? We see equal lows, sweep of liquidity, gives us a point of interest. Price then continues moving to the upside. This is happening all the time, and it's our job to understand why it works and being able to put us in the best probability to win. When we can combine breaks of structure and sweeps of liquidity to our supply and demand zones, it adds such a high value probability of these zones being respected. But again, it comes down to understanding that in most cases, a supply and demand zone is going to likely get some sort of reaction, but we want to see, do we get an actual follow through or not? We can trade the reactions, absolutely, but we need to make sure that we are also being mindful of what's happening around price action, what we're interacting with, what market structure is suggesting, and what liquidity is telling us. Because again, if we're looking at this situation, this was a valid demand zone. We broke structure, we took some liquidity, we do get a nice reaction, but now we're looking at the overall higher time frame picture. We're still bearish. We are reacting off of a higher time frame point of interest. We're starting to build liquidity, so chances are price is going to respect supply or just barely take out external range liquidity and then start to see a pullback before we get that catalyst to move to the upside. And as we can see, price ends up consolidating for quite some time, takes out a lot more of this internal range liquidity, taps into this point of interest right here, this entire wick, oops, just like that. Move that over, and what we can see is we tap into that. And what we can see, if I just zoom in on this as well, we break structure. That's pretty evident. We take liquidity on this swing low. We tap, break structure, and then continue on. This all becomes inducement and internal range liquidity for this move to actually happen. And what we can see is once we've taken out all of the internal range liquidity that exists, we tap into our extreme. We fill in liquidity voids. That's when we're going to start to see runs on swing structure, and that's what we see. And then if we just look more specifically in here, we can see we get a sweep of liquidity, a break of structure, valid POI that we can be looking at, a valid demand zone that we can be looking at trading. And that's the power of the sweep of liquidity. That's the power of combining it with breaks of structure. What I strongly recommend and encourage now is, again, looking at your charts, framing up your supply and demand zones using the liquidity concepts. If we have equal highs being swept and then a move to the downside, or structural highs and then a sweep of liquidity, or some sort of trendline liquidity, a sweep and then a move to the downside, these are all valid supply zones. On the flip side, if we get equal lows, a sweep of liquidity and move to the upside, it's a valid demand zone. Structural liquidity, sweep of that, move to the upside. And if we get trendline liquidity, something like that, a sweep of that, and then a move to the upside, that's also a valid demand zone. So this is what we should be looking out for when we're looking at our supply and demand zones to improve the overall probability of them playing out. Again, we're looking for reactions and follow through. We can trade the reactions, but it's more important than trying to get the follow through. But we don't know what's going to follow through until obviously it follows through. And that's why it's important to combine market structure, supply and demand zones, and liquidity concepts. That way we can build the highest probability trades. When we can use breaks of structure and liquidity sweeps in framing up our supply and demand zones in combination of the higher time frame structure and higher time frame supply and demand, we create such high probability trade ideas because we're factoring in different components that would strengthen the zones from being respected or not. And then also if we start factoring in how price returns to these zones, whether it's corrective, whether it's V-shaped reversals, or whether it is more rounded returns, that also will improve or diminish the probability of these zones playing out. So definitely take a look, definitely dig into this, look at previous trades you've taken, different markups that you've made, and just identify if they have created sweeps of liquidity beforehand. If they did, chances are that was probably a higher probability zone. But then again, similar to what I had said in the previous video, then we need to start looking at, if we have multiple zones, what is the most high probability zone? Are we creating liquidity? Are we sweeping liquidity? Are we targeting internal range liquidity? Do we have a lot of momentum from one zone versus the other? We need to start comparing and really thinking critically about what's going on, especially when we have multiple zones. Because at the end of the day, our job as traders is to take the information that the markets provide us, frame up pros and cons to particular trade ideas, and run it through a checklist or trading plan or series of steps that say, will I take this trade? Yes. Or will I take this trade? No. And that's as simple as trading ends up being once you have all of these concepts under your belt. But until then, you need to test and understand them, get your own flavor of them, and see what works the most for you, because what may work for some might not work for others. So it's important to do the testing. And I can't stress that enough, because the only way you're going to see this working in action is if you put the time on the charts to making sure that you understand how these improve probabilities and when it makes sense to use them.